Hello and welcome to the Semiconductor Industry Association public webinar series where we discuss issues that are important to the semiconductor industry. My name is Robert Casanova. I am the Director of Industry Statistics and Economic Policy here at SIA, and I will be your host and moderator. Today, we will be discussing the semiconductor industry in 2022, its market trends, and its outlook for 2023. And I am pleased to introduce our panelists today, Dale Ford of the Electronics Components Industry Association. He's the chief analyst, and Dan Hutchinson of Tech Insights. Just a quick housekeeping. After their presentations, we will have a Q&A. I do ask that everyone please provide your questions in the Q&A box and not the chat box. Before I turn it over to Dale to kick it off, I just want to go over some basic industry data points from 2022 and sort of give some context for the market in the previous year. At the end of 2022, we found that global sales revenue grew by over 3% in 2022 to $575 billion, according to the World Semiconductor Trade Statistics Organization, WSTS. Specifically in sales into the Americas, which predominantly is to the US, sales grew by 16%, which was the highest growth out of any region. Followed by 12.7% in Europe and 10% in Japan. As far as specific semiconductor products, sales of logic and memory really dominated sales revenue market share at a combined rate of 53% of sales in 2022. And analog devices, these are devices that are used in industrial applications and the automotive industry, saw the highest rate of growth at 7.5%. In terms of end-use markets, the auto industry grew by almost 30% in 2022, which was the highest end market or sales growth in any end-use market. And it really showed that some of those industries that were disproportionately affected by the chip shortage in 2020 and 2021 really saw growth in the sales to their industries. So what are some takeaways from these data points? Despite the downturn in the second half of 2022, the industry really finished strong, and the industry was able to actually break the record set in 2021, the sales record of $556 billion. Which was at that time the highest recorded year of sales in the industry. Another point that's important is that the semiconductor industry is highly cyclical. SIA posted a blog post recently that really gives a good overview of the semiconductor cycle and those market trends that really affected the industry in the past 3 years or so. But despite the downturn in the industry in the second half, those short-term effects really did not deter the industry's long-term growth prospects. And we know this because as of today, there has been announced private investments of over $200 billion in the industry. And this is not just semiconductor companies, but also those companies that provide those raw materials and equipment. In addition, those announced investments potentially will create over 40,000 jobs within the semiconductor industry, which in itself is great for the industry and for those communities that are going to directly benefit from these announced projects. So with that, I want to turn it over to Dale Ford and kick off the webinar.
Thank you very much, Robert. It's a pleasure to join you and Dan on the webinar today. Let me just get my screen up here and move into slide mode. There we go. Great. Well, there's a lot to cover, and I'm going to work to cover as much as I can in the time that we have here. We'll both look backwards and forwards in terms of what we're looking at. At the Electronics Components Industry Association, we're particularly focused on the supply chain elements. And so that has been a major issue, of course, especially in the past 3 years for the semiconductor industry. So I'm going to take a look at the supply chain issues as we see them playing out, and then wrap up with some comments on the economy and how it's impacting our industry. So we'll begin with looking at the cycle and some data here. You just shared the growth numbers for worldwide and America's growth in the semiconductor industries. We also track the passive components. So I'm sharing here the capacitor, resistor, inductor, and then the combined markets of those three and the growth that we've seen in those three. And we'll see that there's some interesting parallels between semiconductors and passive components. The good news for semiconductors is that worldwide, 4 out of the past 5 years, the industry has achieved growth, which is really nice to see. Of course, we're going to have a little bit of a tough go here in the near term, but overall, we've seen a very strong overall performance. And in particular, if you compare the growth in the semiconductor industry in the Americas compared to the worldwide growth, we see that the Americas has consistently outperformed the worldwide growth. So we've seen a particular surge in the semiconductor markets here. Now, we have only the first 3 quarters of growth for the passive components. We're on the brink of having the full year of 2022, but here I show the first 3 quarters of growth in the passive components area. And interestingly enough, again, on a worldwide basis across the board, we're down in all the categories, whereas in the Americas, we see a very different picture. So, not just in 1 year, but for multiple years now, we see that the Americas is a very positive market overall when compared to the global electronics component space. Now, as I mentioned, we can see some parallels between the passive components and the semiconductor industry. And here, I've charted out both revenue growth and unit growth. And if you look at this, going back in time, this is on a quarterly basis. If you go back, all the way to the 3rd quarter of 2017, one of the interesting things I note is that recently the turning points, and I've looked at this with GDP, but also you look at the turning points, the shift in capacitor revenue growth and in unit shipments is actually a bit of a leading indicator for the semiconductor industry. I won't go and discuss each individual point, but if you look at this chart and you study it for a moment, you'll note that there is a parallel dynamic here, but in addition, the capacitors appear to be somewhat of a leading indicator for the semiconductor industry. The one area of concern is most recently the unit shipments of capacitors have gone down significantly, not followed quite as quickly by semiconductors. And my hope is that the semiconductors won't go on quite that strong of a downward slope on unit shipments. But if we look at the revenues, we are very much aligned at this point. Now, we measure orders in the North America interconnect, passive, and electromechanical markets. And we compare the current week with the same week from a year ago. And so here you see the data that we publish on a weekly basis. And you'll note that we hit a turning point where we had been very strong in year-over-year growth on a weekly basis up through the end of 2021. When we hit 2022, we hit a transition point during the first half of this past year. And then we moved down more solidly into, consistently orders underperforming compared to the year prior. In fact, if you look at this up through week 6 of 2023, you'll see that we're, typically 40% down from what orders were in the prior year, sometimes even 60% down in some weeks. And so This has been, consistent now for, coming up on a year now in terms of the comparison year over year. So we do see that, we have a solid downturn in place. We also will see a similar figure if we look at the semiconductors. But again, this is a broad-based downturn in electronics components, not just in semiconductors at this point. Now, focused in on semiconductors, we see that the quarter over quarter growth, it did dive down, nearly 15% down compared to the same quarter of the prior year. By the time we'd reached the end of 2022. The annual cycle, of course, lags that. Thankfully, it came in at plus 3.2%. So positive, but still notably lower than what, I don't know if to say expectations or hopes for the overall annual growth would be in 2022, but it did wind up positive. And so the question that people are going to start asking are really two questions. Just how negative, how deep could this go in 2023? And also, we've talked quite a bit about a soft landing and the desire for a soft landing. And one of the questions that comes to my mind is really, what does a soft landing look like? We can look at figures and images. We can look at the markets from multiple perspectives beyond just, charts and figures. And in some ways, this is a little bit of a harder landing if you just look at the slope of the downward curve. But on the other hand, there are other factors that bode well in terms of what's happening with the management of supply chains and the management of inventories in this cycle compared to previous cycles. So there may be some learning that's been applied that will help, shall we say, soften the blow that we're experiencing as we go through 2023 at this point. The other thing that I think is important to note is that the demand drivers are shifting, strongly shifting away from your standard consumer electronics products. One anecdotal point, but it's worth noting, if you go to the Consumer Electronics Show, typically at the Consumer Electronics Show for many years, it's been dominated by announcements with smartphones or televisions. We went up the larger screen sizes, the higher, pixel densities, et cetera. But if you went to the Consumer Electronics Show this past year, 2 years ago, there was nobody there back in the show, last year. But the show this January, it was very notable that displays, TVs, smartphones were in the background. The real exciting areas that were being announced were areas around sustainability, energy conservation, green technologies, automotive solutions that fit into that. Those types of solutions and technologies really dominated all the companies and what was taking place at the Consumer Electronics Show this past year. So if you want to look at growth opportunities, if you look at the Consumer Electronics Show perhaps as an indicator, I think you're going to see a strong shift towards industrial and the green types of technologies that we're working to adopt on a global basis. Continuing on, this will just look briefly at the splitting out the DRAM flash markets from the other markets. It's important, I think, to look at the distinct pattern between the two, because yes, we did wind up on a quarter over quarter basis being negative, but if you look at everything but DRAM and data flash, we only dipped slightly negative with the downturn that's been going on back since the summer of 2021. So the growth has been softening. And this, again, I come back to this soft landing idea. Yes, it's been softening and we've had a downturn and it's been steeper lately, but the top line number is really exaggerated with the DRAM data flash, what the total semiconductor market looks like. So I think that's important to keep in mind. And if you look at the major categories altogether, we now are, pretty much unified in a downward cycle across the board. But interestingly enough, analog ICs and discretes still wound up the year positive in terms of the growth rate. And in fact, in the Americas, as I've mentioned, the Americas are actually performing better on a consistent basis than the other worldwide markets. And all of the components wound up in positive territory with the exception of memory and sensors and actuators by the end of 2022. So, while there's concern, I think there's some encouraging points that we can draw out of this, particularly in our own region. The one thing that I do have to comment on is while pricing at one point was kind of holding up the revenues, now we see that the pricing dynamic is now undermining the growth as we move forward from that temporary boost. Looking at the comparison of cycles over time, this is a chart that I really like to show, and I show it consistently, is comparing all of the cycles in the semiconductor industry. And I normalize all of them at 0% to the point where they begin to improve over time. And then I start them all at month 1. And the heavy black line you'll see here is the cycle that we're on currently. And if you compare this current cycle, you'll see that, oops, I'm sorry, I just jumped out of presentation mode. Let's go back. You'll see that we had a very healthy, strong, extended period of improvement in the growth pattern that from bottom to top, it was a 40% improvement in growth, which is nice. Earlier years when the industry was smaller, yes, we had higher growth rates, but for recent years, this has been a strong cycle and an extended cycle that went out for 29 months. So in a world where the typical cycle lasts, roughly 47 years, 48 months, we've been on the upside of this for 29 months now. Now the downside slope was a little stronger, but I think that's one indicator of when can we expect to see things improve and turn around. We're roughly coming out to around 39, 40 in this cycle, and so that would indicate that in about another 3 quarters we could start to see improvements if historical patterns hold. Looking forward here, this is where I was noting that perhaps we didn't come in quite as well as we'd hoped for. If we look at the WSTS growth forecast, the last 4 forecasts that have been posted, I showed worldwide and the Americas, the spring and the fall forecast from WSTS. What we'll see is that, we had hoped for, in 2022 that we'd have a stronger growth, and the hope was that even into 2023 that we'd stay positive across the board. But we came in notably lower in 2022's growth on a worldwide basis, and now 2023, acknowledging that we are going to move into a negative range worldwide. But again, on the Americas, we're still holding out hope that we can sustain an overall full year growth in this year that will remain positive. It will dip negative at some point during the year, but the forecast from WSTS is calling for an overall positive growth by the time we reach the end of the year. And then again, as the typical pattern, they wind up coming into the 5% range in the long term. But it is notable that after a decline in 2023, that looking at in the next year, they have worldwide growth up at around 8% range, and in the Americas up around 10%. So that would be a very healthy return to growth. Now, at ECIA, we conduct a monthly and a quarterly survey of participants in the supply chain, manufacturers, distributors, and manufacturer representatives. And we ask for their assessment of the sales performance in the current month compared to the prior month, and looking also to the next month compared to the current month. And so this is the most recent data that we've published that has the January results, and looking forward to February. Here in about a week, we'll have updated results, but you'll see that we hit a very deep low in November across the board in all of the component categories, with the exception of electromechanical, but low even there. And November was not a happy time, I would say, as you looked at people's assessment of the sales environment. But the good news is that December and January saw a marked improvement. We're still below 100. Anything below 100 indicates that the feeling is that we're seeing declining sales compared to the prior month. And so we're still below that 100 benchmark, but we're not at the depths where we were down as low as 50 on the index here. So some encouraging turnaround, still not above, we're not above water at the 100 point, but And in February, we didn't continue to see the improvement, but I guess I would say that we kind of consolidated the gains that we'd made in the prior 2 months. And so we're seeing an improved sentiment in how people see the markets here in North America, but still not assessing things are going to move into the positive territory right now. If we look at the overall market by end markets, so instead of looking at the components like I did on the prior slide, if we look at markets, by terms of consumer electronics and smartphones and data processing computers, et cetera, we look at those markets and we compare those who see the coming month being worse than the prior month and compared to those who see it better, again, we saw a real spike there in November in terms of those who saw the market really declining. And that's a continuation of what we've seen going back to really the summer of last year. But again, thankfully, a real drop from that negative sentiment. And so a real nice improvement in that picture. So I guess bottom line, we've gone through a rough second half of the year. We're going to still see some challenges in the current market, but some improving sentiment as we move forward. We look at the supply chain. This was, I thought, an impressive slide for a long time, showing the unit shipments and how those were trending up in a very strong fashion, particularly the shipments in discrete components and also the shipments in analog ICs. Now, they've both now rolled over. We're not seeing the continued increase in unit shipments month to month, but still, even compared to where we were in the previous peaks and compared to where we were as we began the upside of this cycle, still much higher than what we had been historically on a worldwide basis. Same thing in the Americas. The only concern I have in the Americas is the discretes, a much steeper decline in unit shipments that we've experienced recently there. And but the lighter shipments, the lighter demand that we're seeing, that does point to a benefit that we're seeing in terms of lead times. The product lead times, this is the most positive picture we've seen in the lead times in a long time. We're seeing decreased expectations and views on lead times and connectors, passives, semiconductors. Decreasing lead times really dominate the picture now. Here we're showing the view in January compared to December, and December was a big improvement compared to November. So the lead times, and that's been a real pain point for everybody in the electronics industry, we're seeing that move forward. Now, what we're going to see now, of course, is the need to manage the inventory overhangs that will develop, but that's a positive view. Looking at supply chain pressures in general, this is an interesting view that's published by the New York Fed that shows their index of supply chain pressures. And you see the high points previously of the financial crisis, the Japan earthquake in 2008 and 2011. But then the pressures on the supply chain just hit unprecedented levels when we hit the pandemic. But the good news here is that in recent months, we've seen that pressure ease dramatically. And we're back down into a much more tolerable range, I guess you could say, for those participants in the supply chain. So I do believe that we've got another piece of good news as we go into 2023. If we look at the areas of greatest concern, this is the Lehigh University Supply Chain Risk Index. Whereas like a year ago, transportation disruption was the dominant factor in terms of concern. That's now well down the charts, and now the greatest concern revolves around the economic risks. But interestingly enough, cybersecurity moving up into the second rank here, and we've been doing real significant research to support members in managing cybersecurity risks in their companies. But the good news, just a report out here recently, is that the FBI is noting that ransomware, the cost of ransomware attacks has gone down notably in recently compared to where it was previously. So we are making some headway even in the area of cybersecurity. And again, this is showing comparisons. As I noted, transportation disruption was the dominant factor just within a year, but now we're moving up with the economic concerns being the primary concern here. So moving to the economy, a few final comments on that here. We see that this is data from the National Association of Manufacturers, NAM. And in their survey, they noted that 68.9% of respondents felt somewhat or very positive in their company outlook. Now that's down from 75.6 in the third quarter, but still, and it's the weakest reading since the third quarter, but still, that's even higher than what I would have expected, to be honest. We get that reading at the same time that, over 60% believe that we're going to go into a recession this year. But in spite of those worries, manufacturers are continuing to invest in their companies, they've noted. They also note, this is interesting, manufacturing employment rose in the sector by nearly 400,000. That's the most since 1994. Now we've got almost 13 million employees in the manufacturing sector. That's the most since November of 2008. But on the other hand, the other side of that coin, they also note that in December, there were 764,000 manufacturing job openings. And that's and for the average for the past year was 840,000 manufacturing job openings. There continue to be many more job openings and people actively looking for work. For every 100 job openings in manufacturing, there are just 52 unemployed Americans. So we're excited to see the jobs the semiconductor industry is going to bring in, but we're going to have to really work to attract and retain the talent that we need in the industry. And then the conference board, here, this is of concern, of course. We see the leading economic indicators from the conference board, the GDP rate, and the most recent indicators from the conference board, not exactly encouraging. Inflation rate, I've noted this before, and I want to come to just a little bit of a different perspective from what I've shown before and how this impacts semiconductors. The good news is we're off the peak that we hit at 9.1%, down to 6.4% in the latest reading. But, and also we see that the pricing in raw materials, IHS Markit or S&P now publishes, we've seen big improvements there in the raw material pricing that we're seeing. But here we see an interesting comparison. If you look at the last time we had what I would say a real inflation crisis back in the 70s and early 80s, if we compare that to where we're at in this current cycle of inflation, we say, oh, great, the Fed's getting this under control and we're going to see much improvement in the inflation. But caution, we hope that we don't repeat history. If you start again, both of these at the same point in time, you see that we're following the same pattern that the world followed in the early 70s in terms of the inflation rate. And again, if you offset this and you normalize things, we're following the exact same pattern we were in the 70s, where the inflation blew out again after it had been under control. So we're going to need the Fed and policymakers to be very cautious and very careful how they try to manage through on this economy. We don't want to repeat what happened in the 70s. But I do want to end on what I view as a very encouraging note. If you look at comments and announcements, beyond just the announcements, which are great that Robert mentioned of new fabs and the investments, the capital infrastructure investments that are coming on board, technology is still just this irresistible force, and, one report I saw, it's like discussion of death of Moore's Law is like Mark Twain, the reports of my death are greatly exaggerated. You've got TSMC announcing their introduction of 3 nanometer chips second half of last year. They'll bring 2 nanometer in 2025. You see reports from Intel. They're going to go down to now measuring process geometries in angstroms, and they're announcing their Intel 20 angstrom node. And so their new ribbon FET transistor technologies. And I love this quote really from Pat at the Intel CEO. Until the periodic table is exhausted, we will be relentless in our pursuit of Moore's Law and our path to innovate with the magic of silicon. So with that, what I view encouraging and strong note, I'll wrap up and pass it back to Robert.
Thanks, Dale. A great way to end the presentation and provide some, I guess, some optimism for the coming year and 2024. Now I'd like to pass it along to Dan to present his outlook for, or his perspective of 2022 and outlook for 2023.
Okay, should be sharing screen now. Let me put it in the slideshow. Hi, everyone. It's really fun and an honor to be doing this, and keep everybody up to date on what's going on. So anyway, I'm going to be sort of going through what happened, what's been happening, and then where we're going. And oops, did my Zoom? Hello.
Yeah, you're still here, Dan. Dan.
Okay, good, because so anyway, it keeps saying the same thing. It is, this looks like I lost it again.
I think we got you back, Dan.
Modern times. So anyway, just real briefly, I'm with Tech Insights. Everybody who knows me from VLSI, they acquired us in 2021, and we're still pretty much doing the same thing, except for now we've got the world's largest reverse engineering behind us, in terms of the capability that they have in Ottawa. So why is it? Okay, here we go. So anyway, let's talk about the silicon cycle, because I'm going to start off there and then kind of get into where we see things going. And for some reason, my screen isn't working. So, just real quickly, the cliff notes, in terms of cyclicality, because we've had this argument, we go into these cycles and then we start hearing executives increasingly say that we're not cyclical anymore. And it's built into the industry because of the KNZN acceleration principle, which basically says that we follow the first derivative of the economy. And if you're in the semiconductor equipment side, you're following the second derivative of the economy. And then, of course, on the supply side, you've got just all these lags that are built in there, the 2 to 3 years it takes to build a fab, same for ramping a node, and then you've also got this really Christmas-driven demand cycle at the end that drives everything. So, but one of the things, if we go back, I wish I could get my buttons to work on my keyboard, but for some reason they're not. If you go back, a lot of people think, well, if we overproduce, that's the production that causes the cycle. So I went through and I categorized every single year that we've had a cycle back over, decades. And what you can see is that it's kind of questionable, because the reason why people ramp production is they expect sales to increase in the following year. So if you look at the silicon production and then the revenues per square inch in a year +1, what you can see that the most aggressive production cycle resulted in almost no decrease in revenue per square inch. So you really, what you have is a problem of where demand and supply intersect in the wrong sort of fashion. So, and if you actually look at the probability of it, if you have a high degree of production in the following year, you only have about a 55% probability you're going to have negative industry growth. So, and that's really because demand's the other half. Now, and if you kind of ask, okay, where supply, and if you look at the prior peak years, just simply in terms of the equipment market, what you can see is that you get the same sort of thing where, you can have really rapid peaks and not necessarily have strong declines. Other times you have really massive declines. But the most interesting thing is if you look at the history of the industry going back, before 2000, and then looking at it between 2000, 2010, and then after 2010, what you can see is on the equipment side, the actual cyclicality of the industry has dropped quite a bit. And on the semiconductor side, since 2010, the average downturn has only been down about 4% versus 8% over all cycles. And then prior to really 2010, they averaged about down 12% for semiconductors. And, and there's some real reasons for this. It's not just simple, picking and choosing the data, because every cycle is really different. And one of the things when we talk about this cycle, actually, this is from a larger presentation that I gave where I went through every single cycle and talked about what drove those cycles. And if you go back to what's interesting about this cycle that really worries me about the 2012-2013 cycle was primarily driven by the US debt crisis. We had a debt ceiling crisis then. The government was shut down. S&P lowered the US credit rating because we weren't paying our bills. And we had a real problem in our industry. It shut everything down because we need finance quite badly. So then if you go and look at what's happening now, all things look like we should be going into an upturn going in, for the second half of this year. We may get a double dip in 24 if we see if the debt crisis is not really resolved. And so that's something that you should really be watching for between now and in the end of the year. And actually, it's going to hit pretty hard around the July timeframe in terms of whether they raise it or not, and the government runs out of money. So, and then if you look at most recently in 2019, that cycle was really not driven by a macro cycle at all. The GDP slowed a bit, but the real thing is that you had a memory cycle. And I think that the cycle so far has looked a lot like the 2019 cycle, where most of the pain was felt in memory and not really the classic sort of cycle. And unfortunately, so if you come back to say, well, why is the growth risen? Why are we less cyclical? Well, one of the things that really happened is the average fab line cost trend bottoms in between 90 and 2000 after this massive rise up. And we get what I like to call the 300 millimeter holiday, because when the industry shifted to 300 millimeter, it threw off all this perfectly good 200 millimeter equipment. And so everyone that was doing more technology like analog, power, sensors, they could build fabs for about 10 cents on the dollar of what the original fabs had cost. So you had this real flattening, and that really lowered the growth for the industry back then. And then when you come back to the more capacity, what's really been happening is the 200 millimeter holiday is over, 300 millimeter. And what you've seen since 2020 has been just a successive growth in 200 millimeter capacity expansion. So that's one of the big drivers, especially driving the semiconductor equipment side. And sorry. So, and if we just sort of look at the market outlook, what's really happening here is the innovation continues to be exponential, and we see long-term growth for the industry to be relatively high. And more recently, I think we lowered our IC market to 6% growth. If you look at the IC market, it's been growing at about 9% since 2010, and it should probably grow at that amount. And if we take kind of the longer term picture and look at the decadal trends, right? We've been growing. If we grow at 9%, we'll be $1.3 trillion 10 years from now. By 2030, we'll get close to clipping for ICs $1 trillion, and we'll definitely hit trillion for semiconductors, assuming we don't go through. And that just assumes a 0.47% IC content in GDP. I used to pay a lot of attention to IC content in electronics, But now with so many companies building their own stuff, and then also what really is electronic or not electronic has become pretty fuzzy. And we found that the correlation between the semiconductor industry and the electronics industry began to drop off. So we tend to be more macro focused anymore. But to get from here to there, you need about 20. So we're going to hit 27 billion square inches of silicon by 2033, and at a 1% revenue per square inch annual average growth rate, you'll get to, that's all that is. It's not, that's assuming there's really no inflation. Add inflation and we could get closer to a $2 trillion market. But to get there with this amount of silicon, we're going to need about 105 new gigafab equivalents compared to what we have today. That's 100% more than what we have today. So it's quite a growth figure. So I'm sorry, but my mouse is the only way I can seem to forward these slides, and it's just making a mess. Something happened to my computer today. I think, the smartphone clearly, as Dale was saying, it's kind of slowed, and it's really, the smart auto is the new smartphone. That's what's really, it's the new queen of the market that's going to drive us. And the reason why it's going to drive us is real simple math, right? Is an EV has about 7 times an ICE chip content. And if you look at the size of the EV market, it has 10x the growth potential of anything else that's out there. So really the next big thing, NBT, is really going to be, that's what's going to displace the smartphone. And we've definitely seen that in this cycle. And in terms of technology, at the macro level, we've got all kinds of things happening there. Semiconductors, we've got the law of P-packed T, power, performance, area, cost, and time. Lots of new technologies, equipment, we have new technologies. One of the things that's really happening in this cycle that looks a lot like the post the 81, 82 cycle, you're seeing the equipment market looking like it might actually do better. And you saw ASML come out and say, we're going to do 25% growth. Well, there was a halt in Moore's law between 76 and 1981 as the industry dealt with the lack of a new lithography technology. And that's exactly what's happened with EUV as we've gone from immersion and we couldn't get EUV going. That's now finally here. So, and then if we spin down the device types, whether we talk about DRAM, NAND, tons of new technology, and then LAP, logic, analog, and power. You can see one of the things that's really driving us forward is just tremendous amounts of technology that, where Dale was kind of ending his presentation on. Our forecast is that we think that, by the third quarter, we'll get a pretty flattish quarter and then come back with a strong fourth quarter. This is assuming that there's not a debt crisis. If you look at 13-week moving averages, what you can see is that this cycle, the red line is auto. A lot of the shortage was really just driven by this dip down here in auto that came back and reversed. But auto is still positive. Analog and power is still positive. And this data was just updated through last week. Logic has gone negative, but it's really a memory cycle. And so if we were to, span back to say 2019, you'd see the same sort of memory cycle. In fact, you see it a little bit back in here where it's coming out in 2020 of a huge glut of memory that was caused by too much NAND. And we've seen this as the data centers and the hyper verticals, kind of hit the wall where they could no longer just spend money like they were the central bank and could print their own. You have you've had this kind of a cycle here. And that's the interesting thing, because if you look at the US economy, or most of the global economy, China was down, the US was down in the first and second quarter, but it was on a nominal basis, not a real dollar basis. On a nominal basis, the economy was actually growing. And in fact, the last quarter, it was like 6.7% versus 2.7% real growth. And that inflationary effect is still driving through. But in semiconductors, which are getting this huge deflationary impact of the collapse of memory because there's just too much supply. And this is a long-term chart also going back. This shows a 13-week moving average of semiconductor sales. And you can see we're still heading down in the cycle. And we peaked at 34% on February 22. We had a prior peak in 2021. It matches the 2017 growth peak. And the only thing we have that's bigger than that is really this, and where we have weekly semiconductor data, because we didn't start collecting it till around 2009. After as we got into the middle of the 2008, our customers kept saying, we need faster, more relevant current information. So, but you can see, and you can also see here what I call the fear index, which is just 52-week volatility. It's still relatively high. There's a lot of fear out there, even though what we saw is since September, things have been popping. If you look at where we are in terms of trend lines to 2030, which here you see the orange line is a 13-week moving average. The blue line is a 52-week moving average. This is IC sales only, and you can see that when we do a polynomial fit around those, we're still heading towards $1 trillion, especially if you add the discrete sensor part of the semiconductor industry into it. So even though we've had this huge dip, it still hasn't bent the curve significantly in terms of our long-term trend. This is just our most recent supply demand picture. This is a big data program that we run, and as of last week, auto has been in shortage since really 2021, and that hasn't changed on a weekly basis. Analog and power finally moved out of tight and went to balanced last week. The DRAM is still saturated. NAND has been bouncing around balanced. That's largely, a lot of this is measuring, when we talk about supply demand, we're really looking at who owns the pricing power. When it's balanced, it means that we're not seeing a lot of pricing moves. And in the case of NAND, essentially it's hit cost bottom, and so we're not seeing a dip there. So and then when we look at electronic retail prices, they've been pretty flat. Excuse me, they were pretty flat at the end of 2022, and then going into 23. Sorry, my camera blocked my 23 thing there, but they have been going down this year, reflecting that there's still more price pressure coming in to the marketplace. Capacity utilization has fallen. It's about 10% off peak levels. It's right now, fab utilization is in the mid 80 percentile, and test and packaging is closer to around 80%. And that's pretty typical of a slowdown. And that should be ameliorating the industry. Someone was asking about production capacity. One of the things we do is we convert all the spending plans into planned capacity. If you add current, which is the red, to the planned, what you can see is that there's still a lot of capacity. What we are seeing is that it is being pushed out. The plans aren't changing. It's just when they're planning, the amount of which, the aggressiveness in which they're planning to do the tool placements is spending out. One of the problems that we had in 21 going into 22 was that there wasn't enough white space of empty fabs. And so what you've seen is a lot of these announcements are just simply to get to the point where you have the white space available. Two reasons why we're less cyclical, which I guess I pulled the slides out of my other presentation, is inventory controls are a lot better, even though they're at the highest levels we've seen since 2008. What we typically saw was inventory to billing ratios no more than around 2.0 since the 2010, 2011 timeframe, as the industry began to use tight inventory control, where before, like, it would swing into the 4-month category industry average for total inventories. And then, of course, the other thing that happened was, instead of having to build out the entire fab and bring that capacity online, we developed ways in which we can just expand the fab incrementally. Once we went to 300 millimeter, we could use it in many environments, and that really changed the flows of capacity into the production cycle. We look at inventories, historically, what we'd see like is a peak here around 1.5, and we'd see the industry pull back. Everyone freaked out, and it just went crazy. As of this is as of December, January timeframe, it's above 2.0. We haven't seen a 2.0 number since the 2000, going into the 2008 cycle, as we began to cycle into that. And you can see the inventory continued to build, but with the reductions in production, this should start to begin to heal itself going into the end of the year. The only question is do we get some sort of a new macro dip that hits us late in the year and goes into next year? And then, this is where, my big concern is that we could have a big double dip, and we could just fall off the cliff all over again. By the way, if you ever go to Glacier National Park, this place is called Salt Lick, and the goats will just climb on the side of this cliff and lick the salt in the rocks. As for inflation, that's the biggest concern. And I don't think the Feds, Dale had the chart of the double dip. What happened in what happened in those 70s period was, one is there's a huge buildup in the 60s because of the Vietnam War and Johnson's Golden Society, huge amounts of spending and cash floods into the economy. And then in the mid 70s, Arthur Burns waffles and lowers interest rates, because he was afraid, the industry, it looked like the economy was turning into a recession. So he waffled, and that's why you get that double dip in that period. And right now, all of the things I read, the insights, the commentary indicates that the Fed today is and certainly Jerome Powell is afraid of being remembered as the Arthur Powell, because he didn't pull the punch bowl away from the party, which was the Chesney Martin's rule was one of the earlier Fed reserves, or the job of the Fed was to pull the punch bowl away just as the party got started. That didn't happen. Inflation is going to be an endemic problem, and I don't see that people in the Fed and most of the macroeconomists, they tend to see it as a contained US problem and not realize that a lot of the deflation that came, the very low inflation levels that we've had for the last 30 years was because of globalization and an influx of low-priced goods coming out of China and the United States. And in terms of how the balance sheet gets calculated and inflation gets calculated, those lower prices of goods coming from China get calculated as an income effect. So I think inflation is a longer term problem, and which could really change the long-term revenue picture for our industry when we start to look at how we're forecasting, where most of the stuff, the forecasts you see, like what I showed, is essentially a real forecast with minimal inflation. Hoarding, the funny thing is we've got all this inventory, and at the same time we still have shortages, and there's still signs. We still hear people talking about hoarding, and Dale was talking about lead times being stretched out. So, but on that, I think I'll end. I think I'm, pretty much my time is over. So let me stop sharing.
Dan, thank you so much for that very insightful presentation. Just to open up the Q&A, just one question on the growth perspective or prospect for the coming decade. Dan, you mentioned there's a possibility, by 2023 or 2033 for the industry to possibly reach $1 trillion. How much of that will be dependent on growing demand in say, the auto industry or other industries? As you mentioned, demand for EVs is growing exponentially. but the technology in those EVs, are they going to be leading edge, or are they going to be, current? I'll let you.
It'll be a mix. It'll be a mix. And the other interesting thing about the industry is if you look at the longer term, and if you just look at silicon growth, right, area of silicon, it tends to be this nice, beautiful straight line. And when you start parsing it out, what you start is you see the early growth period was there was this it was military, and then military plateaus, and then you get mainframe computers, and then mainframe computers plateau. You get minis, you get PCs, then you get the smartphone. And what we have is we always have these new demand drivers that come in there. If I was going to worry about demand falling off, I would worry more about self-driving cars than anything. Because one of the reasons why the EV market will really support us is like the PC, the auto is one of the most underutilized products in the world. It's only the utilization of the average car is around 5%. And that's why the auto market drove the global economy in the last century was, but most of the time, car spends its time parked in the parking lot at work or parked in your garage at home. And, but if you get to the world where some of the self-driving advocates talk about where you could actually see a collapse of that whole infrastructure, and we'd have to find something else. Maybe it's data center. There's also an incredibly strong correlation to growth in our industry, to simple growth and bits trafficking the internet. Because all those bits trafficking the internet have to cross through semiconductors. And if that grows, semiconductor demand grows with it. And that's the other sort of part of our that I did mention is that really the longer term baseline driver is going to be this whole interconnected world that we have with the internet. And of course, none of this all assumes that there's no war in the South China Sea.
Great. Dale, do you want to, do you have an answer to the question of what other industries besides auto is going to really drive demand and growth in the next decade?
Yeah, just a couple of thoughts. I agree with what Dan has said. Picking up on the data element, I believe that in the macro sense, the creation, transmission, storage, and management of data will continue to be one of the most important drivers of demand for semiconductors moving out into the future. We thought we made a big jump when we moved from audio to images to video. Well, at the last CES, we were seeing some very impressive, I think, finally, virtual reality and augmented reality have arrived. That brings a whole new dimension. And so, and all the other applications that will rely on data. So I believe data is very critical. Then from more of a macroeconomic driver, I believe that we need to look at what's happening globally. The electronics industry, semiconductors, were one of the greatest beneficiaries of the open and free trade environment that we've been in. As that is ending, and we're seeing the major conflict, especially between China and the rest of the world, that's shaking the whole world up. And whereas China might have been the next natural location for migration of semiconductor manufacturing, clearly, that has been, we've thrown the sand in the gears there. The US and the West is saying, we're not going to transfer this equipment to you that can be militarized. But on the other hand, I think one of the great opportunities, and the US has to catch up a little bit, is the pursuit of development of opportunities in the developing economies of the world. There is so much opportunity that's still untapped. If you want to look to South America, if you want to look to Africa, if you want to look to these Eastern European countries, there are so many opportunities to have increased adoption of technologies and solutions that I believe it won't be a free trade global environment. It's going to be a competitive environment for those who want to go after those economies and benefit.
Great. Well, we're at the top of the hour now. I want to take the time to thank Dale and Dan for their very great presentations on the industry, not only in 2022, but 2023. I do want to remind everyone that A recording of the webinar will be available on the SIA website, as well as the presentations starting tomorrow. Again, thank you very much, Dale and Dan, for the very insightful information. And that concludes our webinar.
Thank you.
Thank you.